Kirk Chisholm is a wealth manager and is principal of Innovative Advisory Group. Kirk is a market veteran with over 20 years experience, and his mission is to help other people understand the mysteries of the financial markets. Kirk is also host at the Money Tree podcast, which Chris Tate recently appeared on. Kirk, hello and welcome. Thanks for coming on to Talking Trading.
Yeah, thanks for having me on. This will be a lot of fun. Looking forward to it.
You refer to yourself as a wealth manager who thinks outside the box. Can you define your view of risk management?
Yeah, that's a great question. I mean, so we look at risk management very different than I think most other advisors do. The industry itself.
It's reassuring.
Yeah, I know. You don't want to. You don't want me to spill all the secrets of the industry here. It might not be a good thing. But I think the industry uses this risk management technique of diversification. They think, hey, you just diversify and everything will be great. And I think what they don't talk about is why that works or why it should work. Now, that theory came about from some studies that were done in academia, and Wall Street got a hold of it and they said, hey, this is great. We can sell more mutual funds. So it actually wasn't meant for use in real life, but it did. And I think even in theory, I think there's a lot of validity to it. The problem is that people don't understand why it should work. Now, it should work if you have a bunch of non or low correlation assets that are unrelated to each other. That should work in the real world. The problem is most people diversify and they don't understand that pretty much most things are correlated now. So you're not getting the diversification that you think you're getting. And if you don't believe me, look at any of the big market sell-offs in the last 12 years. Look at 2008, look at March of last year, look at a few other times, 2015, it was the end of the year 2017, we had similar things. So basically what happens is, take 2015 as an example, the oil market plunged. It was from over $100 a barrel down to in the 20s. And so what happened is it started with oil. Oil crashed from 100 down to the 20s. Well, oil crashed. What else is a natural effect of that? Well, oil companies are going to get negatively affected. So people start selling oil stocks. And then they think, well, actually, these companies might be bankrupt. They start selling oil bonds. Well, if there were three days in a row, 3 high yield bond funds closed up because the bonds are not liquid. So they couldn't liquidate as much as they needed to when people were selling out. So they had to actually close the fund and liquidate it slowly over time. So what happens is you can't sell your high yield bonds. What do? Well, I'm going to go sell my corporate bonds. I'm going to sell my treasuries. I'm going to sell my Apple stock. No, those stocks had nothing to do with oil. Right? Or those bonds had nothing to do with oil, but it's a liquidity issue more than a solvency issue. And this is what happened in 2008. It happened in 2015. It happened in 2017. It happened last year. And you think about all these companies that, think of like an Amazon or a Zoom or some of these tech companies that should have done really well, but they still crashed. Gold crashed, cryptocurrencies crashed, because it's not about the validity of the investment. It's about the interconnectedness of the financial system. And because of that interconnectedness, you can't, when you've got billions and trillions of dollars sloshing around and you have to sell because everybody else is selling, where do you go? And so the diversification that worked in the 70s and 80s and 90s, it worked because the system was constructed differently. Now the system is actually kind of messed up because of all this correlation that people have interconnected with the institutions, because the institutions are what correlates the assets. And
so you're saying institutions control the money in the markets?
No, they're not. It's not a deliberate attempt. It's just, think about it this way, just like we talked about, right? If you need to sell, then you just sell whatever you have to sell. Well, there's thousands of institutions out there that are getting the same orders. It's not their job. They're not manipulating the system. It's just the system is set up so that, I'll give you an example. Indexing. Index became a big thing because in 2008, people found it was just too hard to pick stocks. All the deep value investors were picking some of the bankrupt mortgage companies because, hey, they were a good value until they weren't, until they were worth zero. But a lot of people found it was, yeah, I mean, yeah. I just saw that movie, The Big Short, the other day. Classic movie. It's one of my favorites. And, you know, if you think about what happened back then, people found it was just too hard to pick stocks. And frankly, it is, because the system is not based around price discovery and fundamentals anymore. So it's easier just to index. Forget the indexing outperforms, you know, conversation that people have and say, well, indexing is great because, you know, it's low fees and all this. Let's remove that argument. It is just easier to put money in an index than try to pick stocks and pick winners. That's the reality. And so when everybody's indexing, you create this problem that nobody talks about. And you think it's like over 50% or 60% of funds are being indexed. And so when you think about that, that creates a problem, so that indexes are moving the market. So who are the biggest stocks in the index, right? The FANG stocks, a few others. Well, if you're indexing, money goes into those stocks, which boosts up the price of those stocks. Well, those stocks go up, so more people put money in them, which boosts the price of the index. So it's this positive reinforcement loop that causes it to go higher. Well, it also works in reverse when it goes down. And so that's how the markets work. It has nothing to do with fundamentals like it used to. It used to work in a more fundamental driven way where there was price discovery, but now there's not even price discovery. So there's a lot of issues that kind of come along with this infrastructure that is built, and you can't disconnect it. But there will be a point in time where that will tilt the other way, and where price discovery will come back into true form. But right now, that's not the way things work.
What would cause something like that to tilt it?
Either getting so many people are indexing that the people who are, there's actually a lot of theory around this, and it's hard to really say. I've talked to a lot of smart people about it, and they have some really good theories, but you don't really know. The best theories I've heard are so many people index that the active fund managers are the ones driving the price because everybody's doing the same thing. So this small group is actually driving the price because they're the only ones making decisions, whereas everybody else is just sitting on money and it's not moving. So technically, if you think of, there's like 1 million shares outstanding, and, you know, 900,000 of the shares are sitting and they don't move, like pensions and, you know, these big funds that don't go anywhere. But then you have 100,000 shares that are trading every day. Those are going to move the price up and down. Whereas these aren't moving because the prices aren't being discovered because they're just sitting there. It's permanent money. It's illiquid. It's not part of the float. So, so if you have these active managers are the ones that are moving the shares around, that's what's going to cause the price discovery. So that's one of the best theories I've heard as to what's going to cause it. But primarily it's going to be, I don't know, things would have to fundamentally change in the markets otherwise.
Kirk, can we just shed some light on the industry that you've been in? Because a lot of people don't understand the fund management industry. Fund managers do, like you say, try and hug the index. If they do outperform the index, they get a small to moderate bonus. If they seriously underperform the index, they get fired. That's a consequence, right?
Yeah, I think you must have read one of my posts about.
You bet.
It's we call it career risk, and it's something that nobody talks about. You know, they all talk about how fees are the reason that fund managers underperform, but that's actually only a small part of it. The way I think about it is, if you give me a manager that's going to generate 30% returns a year, I will happily pay them 5% a year. You know, think about it. You're netting 25. It doesn't matter what the fees are. It matters what your net is. And what's a problem is fund managers are pretty good. You know, you look at Peter Lynch, you look at some of these people, Warren Buffett, who doesn't run a fund, but, you know, in a certain sort of way he does. But you look at people like that you can see their performance, you can see how they've done, and active management works out really well. The problem is, so in the 90s, in the 80s, and 70s, when mutual funds were a big thing, it was really important to find active management because there weren't really any other opportunities. And you had good managers and you had bad managers, and they were all over the map. Now, because so many people are indexing And because indexing is such a thing, you can't afford to make big mistakes. So a lot of active fund managers actually own indexes in their fund to get it as close to the index as possible. They call it index hugging.
Index hugging.
Yeah, but think about the way I think about it is, what are the incentives, right? Think about Wall Street is built on incentives. What are the incentives around being an active mutual fund manager? Well, the incentive is if you do really well, you'll get a nice bonus, and not a huge bonus, but a nice bonus. And people will like you, and you get to speak at events, and great, you're popular. But if you miss in a significant way, you get fired.
Yeah.
Well, hedge funds make lots of money. If they win big, they make a lot of money for themselves, because they get 2 and 20 in many cases. So their incentive is to make upsized returns. And if it goes to zero, well, so be it. They'll start another fund. But if you're an employee of a big fund company, your job is to not get fired. Your job is to stay in the herd, if you will, right? Don't go outside the herd, because the ones outside the herd, that's where the wolves get, right? Or the lions get them. Stay in the herd and you'll be safe. So it's not their fault. The incentives line up to keep them in the herd. So I can't blame them. I know a lot of them. A lot of them are really smart, and they could probably outperform the index every single year, but they can't afford to take the chances where they're going to lose big and then they're out of a job. It's not worth it for them.
You're a big fan of alternative investments. Can you define what they are and say why you're a fan?
Yeah, so alternative investments, a lot of people think of alternative investments as like hedge funds or private equity or venture capital. And that's one form of alternative. We look at alternatives as anything that's not a security. So I don't even actually look at hedge funds as an alternative, because hedge funds invest in securities for the most part. So you basically just have a mutual fund that can go long and go short and do some other things, but it's basically a mutual fund. I don't look at that as alternative. Alternative are things that are basically investing outside the market. So things like a horse, rental property, private company stock, fishing rights, investing in, private mortgages, tax liens in the US. There's so many different things you could do. If you're an expert, you probably know where money could be of good use to you. And I look at that as an investment. Alternatives are a great way to invest. There are upsides and downsides, of course, right? So if you're investing in a piece of real estate, it's more illiquid than investing in a share of stock, right? A stock that shares, trades every minute of every day. Whereas real estate, it might take you a month or 3 months or 6 months to sell a property. So it's more illiquid. Now, if you're buying, that's to your advantage. If you're selling, it's to your disadvantage.
Most massively, right? Yeah.
Right. So it's one-sided. So it's great if you're buying. And it's great if you're in a buyer's market and you're buying, you have to time it right. If you ever need to sell really quickly, you're gonna get burned. And I think that's really the understanding that you need to know, is that if you're, I'll give you a good example. So in 2008, there were a lot of these things called private REITs. So there's public REITs, which you can buy in the exchange, and then there's private REITs or privately traded REITs. And private REITs are basically things you have to sign a subscription agreement. It's like a private fund. It's a REIT that invests in properties that you effectively sink your money into, and they pay you income, and you hope you can sell it at some future date. Yep. They all claim, oh, we're going to sell our portfolio in 6 to 7 years and it's going to be great. And some of these funds will never, ever, ever sell their portfolio because they make too much in management fees. Well, talking about incentives again, right? So what happened in 2008 is a lot of these funds that claimed, here's the valuation, here's what we do, and everybody was all happy. And then 2009 hit, and then people were like, I want to cash out of my real estate. Sorry, we can't cash out because we don't have any liquidity. So what was valued at, $100 a share is now worth $20 or $30 a share, because, hey, if you're willing to give it up for 20 or 30, you can always find a buyer. Well, funny enough, there were actually exchanges that came on that were marketing these things, where you could go to an exchange if you really needed to cash out, you could cash out. And I didn't find out about these till they're too late, but that would have been a perfect opportunity to buy some of these things for 20 cents in the dollar. And they weren't bad investments. They were just temporarily bad because, the real estate market was in the trash. So it was interesting. If you had the cash back then, you could have done really well, but you had to be patient, and you had to be a buyer when people were selling, and you have to be a seller when people are buying. So
You
that's how I look at
mentioned
it.
the management fees that the managers would never have sold them because there was too much in it for them. What people don't realize is the sales-based
Mm.
industry aspect. And can you give us some more enlightenment on it?
Yeah, the industry's changed quite a bit. So when I started out, it was heavily based on commissions. I actually started out in 99, December of 99. Great time to start, by the way.
That was the
The
crash
very
of
end of
it.
the bull market. Yeah.
Yeah, March 2000, right?
Yeah. I learned risk management really, really quickly.
Mm.
So what was interesting is back then it was all about making commissions, right? Selling a mutual fund, making your 6-7%, making your 12b1 fees. But now the industry has pretty much shrunk that quite a bit, and so those fees have, I don't want to say disappeared, but they're more or less kind of being margined out. I mean, you think about zero cost trades. I mean, people are trading stocks and they're doing it for $0. So
Mm.
the industry is squeezing itself out of a profit so that only the biggest players make money. There are still those commissions and fees built in. Brokers make extra money, and we could go on for hours about how brokers are able to double dip, and insurance agents make money on the back end from the companies. We're an RAA, so we only get paid directly from the client. So we don't
Mm.
get paid anything else other than the client. And if we do, we have to disclose it, but we don't. We find that to be a conflict of interest. So I find it's easier just to, client pays us a fee to manage their funds, to manage their family's wealth, and do planning and all the stuff that comes along with it. And it's much more transparent and, above board. So I'm a big fan of that. I don't despise people for making a living, but I've been on the broker dealer side, and I'd be surprised if that industry's around in 5 or 10 years in the way that I started. Because why would you pay 7% when you can get an index fund, which most of the brokers who are charging you, they don't know what they're doing. Our industry is not built around advisors being money managers. It's built around them being advisors and salespeople, which, I spent time doing that. But most of them are not money managers. They're being told how to manage the money. And so if you're paying for a fund or a stock, to me, you can just invest in an index and get the same thing that they're probably going to give you. So you have to be really careful about how you're investing if you're paying fees, and knowing what you're paying them for, because a lot of the big fees that are around are hidden fees now. So you have to really understand kind of what you're getting.
At the time of recording this interview, Bitcoin's retraced a little. I know this is a bomb of a question. Is Bitcoin here to stay?
I think blockchain is here to stay. I think cryptocurrencies in a certain format are here to stay. It's hard to say Bitcoin, Ethereum, all these, you could make many claims. I mean, the first computer companies, none of them are around anymore. So you don't know what technology is going to do. A lot of people said .com companies, hey, if you don't invest in pets.com or store.com or whatever their .com they had, or cars.com, I don't know all the ones that were bankrupt, but they, all of these companies, they said, well, if you don't invest in these, then, all these brick and mortar companies are going out of business. What they didn't understand was that, all these brick and mortar companies can just start their own website. Like having a website company is not a company. Having a company that has a website is different. And I think what's probably going to happen is blockchain will be integrated into corporate life. So, financial services is going to incorporate blockchain into their infrastructure and operations. It's not going to be you buy this coin and it's going to be the next best thing. It's going to be, they're going to invent a coin, they're going to integrate it in their system, and it's going to work. I think that's probably the most likely thing. Sovereign nations are going to come up with their own cryptocurrency, love them or hate them. There'll always be people who are interested in Bitcoin and Ethereum and coins like that. So I'm a big fan of, at the moment, of cryptocurrencies.
Right.
I think it's an asymmetric risk trade. It's hard to argue that you could put up $1 and lose $1 and you could make $20. I don't know how you can give me a casino any casino and give me an infinite amount of money and I will spend it all on those odds. I mean, you don't get that anywhere else. So it's hard to argue that element of cryptocurrency.
I don't know if this is your field, but is Bitcoin a threat to governmental power?
Yes and no. I think the idea of it was, right, it's to decentralize and to create independence in a system, in a world where systems kind of control things. So I think that's a bit of a problem. And I think that these governments they're not stupid. The central banks are not stupid. They're coming up with their own cryptocurrencies in a way that's going to keep their power. So I think that they see the challenges that are facing them, and they know that they can't get rid of them because countries have tried and they can't. It just sends it underground and people are still going to use it. So you can't, they can't make it illegal. So it is a threat to government power, but quite frankly, money goes where it's treated best. And this has always been the case with currencies, right? Think of silver, right? When the US had 90% silver in their coinage. Well, as soon as they got rid of that, all of a sudden people started acquiring and pocketing all of that old currency and saving it, right? You don't find that in circulation anymore because people have found it and then they keep it because it's silver. It's not worth a quarter, it's worth the quarter's worth of silver, which is worth a lot more than the quarter. So what this tends to happen over time, you look at ancient currencies where they debase the currency. They tried to edge out the edges. They carved off some of the edges of the gold coins, and they've used different techniques to stop that. Or they'd make it out of different materials. So now we all use paper, and at some point we won't even have paper because it'll all be digital. So I think yes, it's a threat to governmental power, but I think governments are really good at finding ways to keep their power. So,
Look, talking of governments, and this is just a chat between podcast pals, Joe Biden is putting the US on a path of zero net emissions by 2050 with a $2 trillion accelerated investment plan. Just talking, I know we're not fortune tellers of the market, we're simply investors. But where do you see this growth going over the next few years?
For clean energy, or what specifically? I
clean
think
energy.
So it's hard to say because you have different administrations, you have different thinking. I think unfortunately politics is what's governing our direction, and politics is the last thing you want governing the direction. Good or bad, right or left. It has nothing to do with what you believe in. I'll give you an example. So let's say I think in general, in the U.S., the left, the Democrats, are more or less anti-nuclear, and yet that's one of the cleanest energies around. And people like Bill Gates, who's for all intents and purposes is a Democrat, or his thinking is, and he's supporting nuclear energy. And there's actually a lot of the phase 4 nuclear technology is. I don't think people understand. Like you literally cannot have a meltdown. Like it's created in such a way so it's I think impossible to actually get a meltdown in a nuclear reactor.
No Fukushimas, no Chernobyls.
No, it's my understanding is, and I'm not an expert. I interviewed an expert on my podcast, but my understanding was it's literally impossible for that to happen. Now all the old reactors would have to be replaced because if you look at China and India, a lot of reactors are going up there because they need sustainable power. The problem that we have in this country is all of the clean energy is not load power. It is temporary power. It's wind energy or solar. You don't have the sun at night and you don't have wind all year. So if you don't have a load power that is able to sustain most of the weight, then you're going to have problems. I mean, look at Texas, for instance. I don't know if you heard stories about what happened in Texas, where it got I don't know, negative 29 degrees or something crazy in a state that's not built for that.
Yes.
And they've deregulated energy. And there were people are going to get electric bills for $9,000 for a month because they couldn't get energy. So you're going to pay whatever they want to charge you. so there's all these problems that are potentially happening. And there's things people talk about like a smart grid energy. It's it's really fascinating to see what is coming down the pipe. But I think unfortunately what's slowing it down is politics. Like people have their agendas, they have their constituents that they're trying to appeal to, and nobody is being a leader. Nobody is standing up and saying this is the right thing to do. And I think that it's really a nice aspiration to want clean energy. I think we can all benefit. But to say that you're going to put people out of work, I mean, one of our politicians, John Kerry, said, "Well, we should put all the oil sector out of work and make them retrain and be solar panel workers." I said, "What are you going to move them to China? Because that's where all the solar panels are made." Like, what are you talking about? Like, it's politics. Is what they really need to do is they need to start with small. What politicians are really bad at is A/B testing. So what they should do is A/B test different things on a small scale. So let's try this thing. Let's see how it works. Let's try this thing and see how it works. Or they make these grand things like we're going to go clean by 2050. That's a great goal, but I've heard that for decades.
Yeah.
I mean, and it's not a want or don't want type of situations. I mean, they've been talking about electric cars for decades, and it's more than just wanting to do it, because are you going to put these companies out of business? Do we have an infrastructure to support electric cars? Like, it's not, I'm not the first one to bring this up, but, think about it. Like, if we had electric cars in 5 years, we don't have the infrastructure for that. Where are the charging stations going to be? How long does it take to charge? The battery's going to last. Like, these are problems that we'll get to, but I think what people get caught up in is they want clean energy and they want a safer planet, but it's not that simple. And I think that's the problem is it takes time. You need enough incentives to push it that way. But some of the things that they've tried to do, and this is more of a personal rant, but I think a lot of the governmental things that they do is really just padding the pockets of their buddies. Like they were doing carbon credits, which doesn't solve the problem. You're just trading one problem for another. You're saying, all right, we're going to sell you a carbon credit so you can spend it, but that doesn't reduce the carbon credits. Like you're just making people rich by trading carbon credits. So I think we need some thinking that is a little more outside the box, that people can kind of come up with ways to make things better and not just find ways to make money. So it's a bigger topic, but that's my thinking around it.
It's fascinating. I'm glad I asked you that question. Talking about politicians, you quote a statistic that a very famous US senator found a tax loophole and has been able to make and keep hundreds of millions of dollars.
I don't know which one you're talking about, but they all do that. You're talking about, yes, you're talking about our very own Massachusetts Mitt Romney. Yes.
Yep.
So we have, there's a part of the tax code in the US that has retirement accounts. We call them IRAs. And then we also have corporate plans, which are 401ks, but they're basically governed around the fact that you can put money away pre-tax today, and you can defer taxes until a later date when ideally you'd be in a lower tax bracket. And, people talk a lot about how they can put away money every year, depending on the year and, what you're investing, how much you're putting in. There's some limitations, but, let's say you can put it anywhere between a few $1,000s up to $50,000, $60,000, depending on your age, every year, which is great. And the idea of these retirement accounts was a way to put away money for retirement, to help you save, to incentivize people to save. Now the government eventually gets their cut when you take the money out, but allows you to defer taxes and compound growth tax deferred, which from a numerical standpoint makes a lot of sense. Now, what's interesting is I wouldn't call it a loophole, but the industry has been built around IRAs, around mutual funds. Because when this was started in the 70s, mutual funds were a big thing. So people talked about it. You could invest your IRA into mutual funds, make lots of money. It was a great idea. And what I found to be interesting is that a lot of people have built up this idea that you have to invest in the stock market.
Yeah.
But there's nothing in the tax code that suggests that. all the tax code, they don't say what you have to invest in, they say what you can't invest in. So you cannot invest in life insurance, collectibles, or S corps. Those are the rules. Anything else you invest in. And the world is your oyster. And I've seen a lot of interesting things. Our very own Mitt Romney had publicly been claimed to have an IRA worth over $100 million. And if you think that's a lot, it's not. There are 314 people in the US who have accounts over $20 million. And I'll just take a guess. What do you think the average of those balances over those 314 people? Take a guess.
Their average balance per annum?
No, the average total balance that they have in those 314 accounts. It's no less than 20 million, so 20 million and up. So what is the balance if you put them all together and average them out?
Okay, obviously it's going to be a lot. 20 billion?
No, you're in the right direction.
Too far.
It's a little too far, but that's okay. I like the way you think. It's $257 million is the average if you take all of those. So if you think about 20 on the low side, and there are IRAs worth over $1 billion. I mean, imagine that. You have an individual person's retirement account worth over $1 billion. Now, I don't know what those people did, although I know where they are. I don't know what they did specifically. But I can tell you that it comes along with a lot of creative thinking. And, you know, what's interesting is most people get stuck in this mindset of I have to do things a certain way. I could tell you how you could easily leverage that up really quickly. There are some limitations when you get to the millions of dollars, but you could do it, and it's all legal. It's above board. There's nothing wrong with doing it. And people, you know, rip on Mitt Romney for having $100 million IRA, but I applaud him. I think it was great that he did that, and the fact that he was able to. Peter Thiel, you know, one of the original investors of Facebook, he has, I would guess, over $1 billion in his Roth IRA. Never has to pay taxes on it. Peter Levchin, there's a few others that have been in the media as having large IRAs. It's not a secret, it's public information. You can look it up yourself. But what's interesting is just the idea that you can go and be creative with your money and find ways to use the tax code to your favor. You're not doing anything illegal, you're just using the code as it was derived in your favor. And I'll give you a quick interesting side note for the listeners. When the IRA was created, the reason they actually put in collectibles was a really interesting story. So when they came up with the tax code, they were trying to find ways to allow investors to save for retirement. However, at the same time, some Nazi artwork and collectibles, Nazi, I mean Jewish artwork and collectibles from the Nazis were found. And in creating the code, they created in such a way so that if they were able to put this in the IRA, they would never be able to get access to it. It is that strong of a part of the code. So they put in collectibles specifically for that, so people couldn't put in this stolen artwork and shield it from government intervention. Really fascinating.
Wow. Okay, so before we go, can you give us three top key lessons you've learned in your 20 years experience?
Only three?
Well, you can do more if you want.
Yeah, no, I would say there's a few principles that we kind of live by. One is risk management first. Risk management first. We didn't talk enough about this in the show, but risk management is really the structural element that everybody needs to do. And people don't look at this. They look at how can I get the best performance? Let me give you a quick math problem. If you have $100 and you lose 50% of your $100, you have $50, right?
Yeah.
What kind of return do you need to get back to where you started?
100%.
Right. You don't need 50%, you need 100%. So if you think about it, what's the best way to grow your wealth is not to lose big when the market sells off. So 2008, the market went down, or 2008 and 9 went down 58%. If you didn't lose half your stuff, you would have twice as much money in order to buy whatever you wanted. So technically, if you were in cash, you doubled your money, the value of your cash. So risk management is really important. Most people look at it as a side note. It is literally the first thing we do in every time we invest. Performance is a side effect of that. positive performance is a side effect. That's the easy part, because everything goes up if you're not doing it, stupidly. You can make money easily on the upside. The downside is the hard part. And I think a lot of people don't focus on that. So risk management first is a big part of it. Another thing I would say is really important. And by the way, these are all mindset things that I'm talking about. Another part is what we would call outcome-based thinking versus scenario-based thinking. Most people look at things as an outcome-based thinking. So think of our recent election, Biden versus Trump. What happens if, most people are thinking, well, if Trump wins, then I'm going to invest this way. Most people said, I think, or probably a better thing is, I think Trump's going to win, and so I'm going to invest in this, or I think Biden's going to win, I'm going to invest in this. We looked at it as, I can't predict the future. I don't know about you, but I can't predict the future. If I did, I would not be on this podcast. I'd be on an island by myself with plenty of people serving me, doing all, like taking care of my every need. I can't predict the future. And a lot of people talk like they do, and people talk to all these really smart people, and they think, oh, what are they going to tell me? Where should I invest? Nobody knows, right? Outcome-based thinking is thinking that you're going to know the future or somebody else does. That is not possible. So knowing that that's not possible, you have to look at what we call scenario-based thinking, which is, what if Trump wins? What do we do? What if Biden wins? What do we do? What if nobody wins, which was a high probability of it being unclear, which in some ways it was for many months. So if you look at that, I don't have to know the outcome. I just know that if these things happen, here's how I'm going to react. So as an example, COVID, nobody I knew predicted that. I just certainly didn't. I didn't know it was going to happen, but I was prepared for it. So even though the market went down 30 some odd %, we didn't, because either if it was COVID or something else happening, we were prepared for a potential outcome, which at some point we're going to have a recession, and a very large recession, in my opinion. And when that happens, a lot of people are going to be unprepared. We're prepared. We just don't know when it's going to happen. So we're not sitting around in cash. We are invested, but we also know that when it happens, even if it happens today, tomorrow, the next day, we're going to be prepared for it. So I think those two are really some of the most important things that people should consider. I would say the last thing is just, I don't know how to say this, but don't trust anybody, trust yourself.
Yeah.
It's when it comes to finance, everybody has an opinion. People are frequently wrong. Don't trust me, trust yourself. Like, you have to make your own decisions. We call it in our podcast, we ended off saying, invest in yourself. If you are not an expert, find somebody you trust to work with. But generally speaking, the industry is devious in many ways, and it's not all deliberate. Like we talked about earlier, like this career risk. That's not people sitting in a room saying, how can we, screw over investors? They're accustomed to certain assumptions in the way that they do things, and those assumptions they build on other theories. And if an assumption is wrong, then the theory is not solid. So it's not a deliberate attempt like some people claim. It's more of, you just have to do your own homework. You have to do your own research, your own due diligence. It's really important that you do that, or find somebody you trust to do it for you. I mean, these people, these billionaires that make lots of money, they have teams of people that work for them. They're really smart people, and really smart people sometimes can be really dumb. I call them the smartest dumb people in the room. Like, they're really, really bright, but the industry, let me give you this final, I think, visual here. The way that I can look at Wall Street is this: take 10 people, right? Out of those 10 people, one person is going to do the research. They're going to get in there. They're going to get all the research. They're going to do all the digging. They're going to come up with a good theory. It'll be solid. One person is going to do that research. The second person knows the person who did that research. The third person knows the person who knows the person who did the research. And everybody else hears about it at a cocktail party.
Yes.
That's basically Wall Street. Like, it's Bernie Madoff happened for as long as he did because no one is doing the research. Harry Markopolos did the research. No one else was doing it. It's just the way that the street works. It's not a good or bad thing. It's not nefarious. It's just there's a lot of reasons this happens. You have to trust yourself. You have to do your own research. And that's part of why you're listening to this show. Like, this is about learning and improving and bettering yourself and getting a better framework and ways to think about things. And that's what we talk about all the time, is just have a better framework, have a better mental model of how to think about things. And if you do that right, then, you know, success will follow, but it takes time. Investing is hard and you need to put in the time.
If people want to find out more about what you say, where do they find you?
Yeah. So easiest way to find me. So my company is innovativewealth.com. That's our corporate website. We have a lot of blog posts. I write all the stuff on the site. I also have a Money Tree Investing Podcast. It's just moneytreepodcast.com. You can find me every week there on that show. And we have a lot of great guests, you know, and, you know, that's probably the easiest way to find me. I'm on social media, but I'm really more active on the podcast channel than anything else.
Kirk Chisholm, thank you for sharing your great mind today.
Great. Well, thank you for having me on the show.